I am Ganesh Shankar, the moderator for today's earnings call. I welcome and thank each one of you for joining us today for the Punjab and Sind Bank's earnings call for Q3 FY26. Please note that this conference is being recorded and all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the opening remarks by the management. Should you need any assistance during the conference call, please raise your hand on the WebEx panel or press *3# on your phone. I repeat, should you need any assistance during the conference call, please raise your hand on the WebEx panel or press *3# on your phone. I would now like to introduce the management of Punjab and Sind Bank. We have with us today Shri Swaroop Kumar Saha, Managing Director and Chief Executive Officer, Shri Ravi Mehra, Executive Director, Shri Rajiva, Executive Director, and Shri Arnab Swami, Chief Financial Officer. I would now like to hand over the conference to Shri Swaroop Kumar Saha, MD and CEO of Punjab and Sind Bank, for the opening remarks, after which we will have the forum open for the interactive Q&A session. Thank you, and over to you, sir.
Thank you, Mr. Ganesh, and good evening, everybody. I welcome you all on behalf of Punjab and Sind Bank to the Q3 Analyst Conference call for FY2025-26. The results were declared on 17th of January, and the results were also uploaded in the website. I'm very sure that most of you have been seen the presentation and the bank's results. However, just to keep a brief snapshot of the highlights of the performance of the bank for Q3, I would like to mention the following. The total business of the bank stood at 2,49,499 crores and has shown a growth of 11.75% YOY. The deposits growth was 9.27% and stood at 1,39,202 crores. The advances grew by 15.05% and the same stood at rupees 1,10,297 crores. In spite of the challenges of the CASA in the entire system, the CASA deposits also showed a moderately handsome growth of 8.78%. However, one of the other important component of the liability resources, the retail term deposits has been growing at a very, very handsome rate. And for the quarter ending December 25, the retail term deposits grew at 18.34%. In terms of the operating and net profits, the bank's operating profit for the quarter ending December 25 grew at 22.73% and stood at 594 crores. And for the 9-month period, it grew at 30.18% and stood at 1,639 crores. The net profit for the quarter increased by 19.15% and stood at 336 crores. And for the 9-month period, it increased by 28.02% to 900 crores. The NII grew at 5.01% for the quarter and 6.57% for the 9-month period. What is significant is that we are laying a lot of focus on core fee income, which excludes the treasury and the recovery and write-off accounts. And that traction continues to be positive. And for the quarter end at Q3, the core fee income grew at nearly 29% YOY, and for the 9-month period, it is around 19.33%. Overall, the non-interest income grew at 50% YOY and 51.52% for a 9-month period. The NPA, the asset quality continues to be significantly improved. The gross NPA now stands at 2.60% and it shows a decline of 123 bips YOY. The net NPA of 0.74%, which is as per our guidance given that we should bring it below 0.75%. And we have already achieved that guidance in December, and we have brought it to 0.74, which shows a 51 bips decline YOY. The PCR PCR continues to grow, and here again, the PCR on a YOY basis has increased by 270 bips to 92.23% with TWO, and without TWO, it has shown a significant improvement of 408 bips to 72.28. The slippage ratio continues to be at a moderate level of only 0.16%, and it continues to decline. And the credit cost also is at a low level of 0.05%. In terms of the other parameters, as far as business is concerned, as we have been interacting with you for the last few years, we have been said that we will like to focus on increasing the retail agri MSME segment. And here again, in the December quarter, we have been able to show a consistent performance in this segment, and it grew at 21.94%. The percentage to the total advances has now improved to 57.45%, and we expect that this percentage will gradually go up, and by the end of March 26, we should be at 60%. And next year, for the guidance which we have kept for this growth of RAM percentage, is 70% for the year 26-27. So we will continuously work on this, on the various segments, as you must have observed. In terms of the individual segments also, the retail has shown a growth of 19.58%, agri of 24.29%, and MSME of 22.94%. So all round, in all the three segments, a healthy growth and a consistent growth. In terms of the capital adequacy, the bank continues to be have a good capital adequacy of 16.83%. If you add back the 9-month profit, which we have not added so far as per norms, if we add back the 9-month profit, it is at 18.01%. So it's just 18% overall, which shows that the bank continues to work on capital optimized growth. In fact, the credit risk-weighted asset density, which we call RWA density, has also shown improvement from 61.18% to 58.64%. So overall, we believe that we'll continue on this capital optimized growth going forward as well. Cost-to-income ratio has also declined 370 bips YOY and stands at 60.84%. Return on assets is at 0.79%. We'd like to take it forward, but we'll at the end of 9 months we are at 3 months we are at 0.79. We'd like to take it forward going forward to around 0.80. So these were some of the numbers in terms of the efficiency parameters. If you observe that the progress in the operating profit and the net profit of the bank continues to have a steady growth in terms of the operating and net profits. If we look into from June 23 onwards, there is an uptick and every year in the quarterly operating and net profits. The other areas of what I like to, in terms of slippages also, we find that the slippages also continue to decline overall, and of course we have the significant. We had a retail slippage of 34 crores, agri of 39 crores, MSME on a YOY basis slightly increased, 94 crores, but we don't think that's a very worrisome area. And overall, the percentage gross NP among the three segments has also shown significant improvement. In terms of the SMA 1 and 2, while the sequentially the total amount of SMA 1 and 2 has shown an uptick, but these are primarily the two state government guaranteed accounts, which we have also adequately provided for in our internal books as a standard, but it is backed by state government guarantee. We don't foresee any immediate delinquency situation, but however, we as a precautionary measure and as per the norms, we have significantly provided for in these two state government guaranteed Finally, as far as the futuristic outlook, we continue to focus on branch expansion, expanding our delivery channels through branches, brick and mortar, VCs, ATMs. We have also we are also now decentralizing more and more in terms of operations. We have four new zones were opened during the year. Then zonal offices, another 4 zones are planned for the next financial year. We have now 2 FGM offices. We intend to increase it to 5, increasing another 3, and also expansion of BCs to further to around 6,000. In terms of the other areas which are very important for any bank institution today, innovation, we find that our digital journeys have streamlined. In fact, the digital home loans during the quarter of December, 40% share of the total housing loan sanction was digitally or digitally assisted. Similarly, for the digital car loans, 54% share was total vehicle loan that was sanctioned was either through digital STP or digital assisted journey. So that shows that it is picking up. MSME loans we have just launched, so it will take a bit of time to traction, but we find that the initial signs are very encouraging. In fact, we also now launched the digital rooftop solar and a scheme under STP journey and also the digital commercial vehicle loans. And by March, we'll have a host of other new digital journeys on personal loan, gold loan, self-help groups, mutual funds, second-hand car finance, educational loans. So these are all lined up at very advanced stages. We expect that by March 26, most of these will be actually implemented. A bit of 1 or 2 areas may spill over to Q1, but overall, the traction is that we will continue to focus on smart delivery of our products from the bank side. In terms of the customer protection, we all know that we are living in a very dynamic world, and therefore we need to create multi-layered defense to protect our customers in terms of cyber-related frauds that happen. So we have taken lots of host of measures. We have integrated with I4C, Mule Hunter. The Enterprise Fraud Risk Management Services also has been activated, and much more and more activities are happening in that as we learn from the system. The FRI, MNRL of the negative list of mobile numbers for enhanced due diligence are also being worked on. So we are being very, very conscious of the fact that we need to take all the mitigants that are required to protect our customers in various forms that are happening in today's ecosystem. In terms of future, of course, a lot of technology-driven interfaces are getting created for customers and also for bank staff through various AI-generated chatbots. I think these will all play its role in going forward. And with excellent CRM solutions, the audit systems have also brought in a lot of value to the bank. The security operations centers, also getting upgraded. The CASA back office is one of the very important things that the bank has taken. Important step. There are a lot of news items float around the Mule account process. So we had earlier announced that the savings accounts have been integrated. All the savings accounts were getting opened through activation from the back end. Over 1 lakh accounts have been opened through that. That's the only channel for the branches to open. And now the current account and the non-individual accounts opening has also been made live recently. So we hope that by these robust measures on opening accounts, on customer acquisition, a lot of much more due diligences will be made. The activations will be done at the back end, which is through a centralized software system, and we expect that going forward, these sort of risks that we carry in terms of the challenges of the ecosystem will to a large extent get mitigated. However, we never can be complacent. We need to continuously upgrade our systems and processes to mitigate the emerging operational risks that are coming Forex businesses is also on the pipeline. The centralized Forex division is at a very final stage to be centralized Forex trade finance solution is in a very advanced stage. By March, we intend to complete the project and take the bank in the next year to a much more to increase our Forex business. In fact, we have also approached RBI for the GIFT City and approvals. We are hopeful that we will get it sometime. But at the present point, what the matter is that we have requested RBI for the formal process to give us an approval for the GIFT City. So if that is done, I think the bank will also get a lot of opportunity to do Forex business sitting in India. A lot of other initiatives also being planned in terms of operational cost management, CRM-led generation, AI-driven features, mobile apps, etc. HR initiatives have also been taken to a very, I think when I joined this bank, a lot of questions came from the analysts that how are we building capacities? And we are now in a position where we have got the state-of-the-art processes to do this manpower, not only manage them, but also reskill them for their through various tools, scientifically devised tools. So we are doing it in two phases. The first one has been implemented, and the second phase is under implementation, which takes the second phase particularly focuses on learning and development. I think that would be the key. The first part was on performance management system, target settings, appraisal tools, etc. Manpower assessment, succession plan. All these are primarily the first phase that has been now done. The second phase is getting implemented. I'm very sure these will all get it will give benefits to the bank in the going forward. A lot of various products have been introduced. And finally, if we come to the achievements of the bank vis-a-vis the guidance that we have been given, I think we have summarized the guidance in the last slide, and we find that overall, whatever targets that we have set for in terms of the financial year, we are all in track in all. We have achieved most of them, and also in track in the gross NPA, which we are already at 2.60, and we are very sure that we are going to bring it to below 2.5% very shortly. So thank you very much for your patient hearing. Now we can open up the floor for the discussions. Thank you.
Thank you, sir. We will now begin the question and answer session. Ladies and gentlemen, we will wait for a moment while the question queue assembles. I request the participant to limit their questions to 2 per person, and please rejoin the queue for additional questions. Anyone who wishes to ask questions, you may raise their hand by clicking on the raised hand icon on your WebEx panel. For those who have joined us via audio call and wish to ask questions, please press *3#. If anyone is having connectivity or audio issue, you may share your question on WhatsApp to us at 77386888746. I repeat, if anyone is having connectivity or audio issues, you may share your questions on WhatsApp to us at 77386888746. Before asking the questions, I request you to please introduce yourself and your organization. Our first question is from the line of Ashok Ajmera. Please go ahead, sir.
Yeah, thank you for giving this opportunity. And congratulations, Sahab, Ravi sir, Rajiva sir, all the top management and the other management staff and the staff of the bank for a good quarter, a very good results in this quarter. If you talk about the operating profit also has gone up, the net profit also has gone up, a good growth in the credit also in this quarter of 4.48%. So on the whole, it's a very good quarter, and my compliments to you all for the same, sir. Having said that, sir, I got certain observations, some queries, and some clarifications. So my first question is basically on the overall business and especially the credit and deposit growth. Now, whereas the deposit is at 6-7% 21.26% in 9 months and targeted to be around 8 to 9%, 8 to 10%. Our credit growth target is 15 to 16%. Out of that 10.73, we already achieved in 9 months. So with this kind of difference in the deposit growth and the credit growth, how are we matching our ambition of going for large credit growth of 15 to 16%? This is my first question, sir. If you can just little bit elaborate on that. Though your opening remarks were very, you elaborated everything, but some of these questions need some more clarification, sir.
Sure. Yeah, thank you, Mr. Ajmera, for your kind words, and a very, very appropriate question that you have raised in terms of the mismatch between the credit and deposit growth. And you have rightly pointed out that our credit growth is a bit higher comparatively to the deposit growth. Having said that, you'll appreciate that in terms of in the present situation that what we are in at this point of time, our CD ratio is around 79.24%. And what is interesting here is that while the pressure on the CD ratio may look a bit challenging in terms of managing the overall outlook of the bank's business growth, what I would like you to focus on is that though the total deposit growth is a bit less, our retail term deposit plus CASA the retail term deposit is growing at around 18% plus, and overall the credit growth we are aligning around 15 to 16%, right? So, and also we are trying to, in terms of the various dynamics of the ecosystem, to protect our margins as much as possible. We are also very conscious of that, and we are trying to do a dynamic, strategically and dynamically, we are trying to monitor that how do we fund credit in terms of the various resources that we have. So one of deposits is a very important resource for funding credit growth. So what we are trying to do is this, is our LCR average, liquidity coverage ratio. We feel that if we are able to maintain a comfortable LCR, we can have a leeway in terms of the increase in the CD ratio, so that we don't get choked in terms of our business projections. So therefore, we are doing a very calculated methodology of trying to fund our credit growth. We are not, because as the last quarter comes, the interest rates are getting hardened now. Both on the retail, we have taken a lot of steps. We have rationalized our deposit interest rates, our savings bank interest rates. So these are some of the steps we have taken to maintain the margin. But going forward, we'll take a very quarter-on-quarter analysis. How do we handle this situation of the hardening of rates on one side, and also the impact on the repo rate cuts that the Reserve Bank has done continuously. Overall, at the end of it, what I can summarize my summation is this: we don't feel any challenge in terms of funding our overall credit growth, and we are very confident that we will be able to maintain the guidance that we have been giving you. But on a quarter-on-quarter basis, these things will be monitored and going forward.
Yes, sir. The point well taken, sir. But with a low NIM of 2.59%, I mean, it is continuously coming down. Which alternative source you feel can be cheaper than the deposit or CASA, so that you can protect your NIM also at the same time growing the advances to this level? So what are your views on the NIM going forward with this alternate methods, with dynamic methods which you are using to raise the funds and maintaining the LCR above a comfortable level of say 120 or so? So how do you, from where do you get the cheaper access to the cheaper fund than the normal deposits?
Yeah, point well appreciated. if you see, there are two, three things here in the dynamics of the ecosystem. While it is very difficult to really get a substitute of a CASA, and which is the low cost resources, and the only option for us as deposit is very important is to go strongly on the retail term deposit. So that's why we have also done a lot of changes. While we are growing at 18%, what I'm trying to tell you is this, that in spite of the challenges of the deposit mobilization, we are still growing handsomely at 18% in spite of lowering the rates in the deposit buckets, in various deposit buckets. But the point to be what we have to, in terms of the NIM, if you see that in spite of the insignificant reduction in the repo rate cuts by the regulator, we still in the December quarter, we were still at more or less at the level of September quarter. So that shows that the NIM going below threshold has been. We expect that it gets bottomed out by the end of this quarter, or maximum to the end of by the next quarter. And the alternative is this, that we price our products and we go into the segments of the asset side where we can really get a margin of 3% and 3.5%. And if you see our dynamics of our credit rating, external rating, जो हमारा portfolio है, you will find that we have moved from the AAAs to the AA, and overall we are keeping the balance well. So the AAA at one point of time was 19.49. It is at 16.60 now. AA rated was 22.38. Now it is 26.43. So this is where we create a room for us. And also, as we increase our retail, agri, MSME growth, now you find that earlier in our bank, the agriculture was not growing at any rate which was to be boasted about. Now you find that every three segments, retail, agri, MSME, all the three segments are growing at tandem with each other. And these are the areas where we find that the margins are still possible to go. Because in the corporate world, we will not be able to compete with a low CASA base. It is very difficult for us to compete in the corporate world in terms of pricing of the good rated accounts. In fact, we have let go around 3,000 crores of corporate. We have shed 3,000 crores of corporate loan book just because we didn't want to provide a repricing at a rate which is not convenient to us. So we have let go of those. But in spite of that, we are still growing our corporate book at a reasonable rate. So how do we balance our portfolios? It will be very, very important. But this is a challenge we will like to overcome through our various. So that's why we are saying that as we increase our retail agri MSMEs to 60%, and maybe from next year to a very, very significant level of 70%, this dynamics will play out very, very solidly in favor of the bank in protecting the margins.
Yes, sir. Taking this your point forward of rating and getting a higher yield or higher margin on the advances, what I see is that in NBFC and gold loan, there are greater opportunity at the same time a good security also. But when it comes to the NBFC, we are still on AA kind of a thing, where there is a small business NBFCs which are even AAA minus also, but their business is very, very secured. They are giving to low cost housing, average size is 5 to 7 lakh rupees, and not a single default and other things. But at the same time, we get very good returns. Maybe the interest from 9.15 to maybe 10.25%. So that those kind of strategies should be relooked. They should also be looked at. Similarly, for the gold loan also, I would just like to know the composition of NBFC and the gold loan. And gold loan also, how much is the agriculture and non-agriculture and the kind of yield we are getting, sir?
Yeah. So first of all, from your first point is regarding the taking exposures in the NBFCs with a lower credit rating. We will take your feedback and we will look into that strategically in-house to see what we can do. I think it's a fair point that you have raised. And regarding the agriculture gold loan portfolio, I request Mr. Mehra to come in here.
Good evening, sir.
Good evening, sir.
With regard to the overall gold loan portfolio of 4,800 crore rupees, 1,700 crore rupees is through co-lending, and out of that 1,000 crore rupees in agriculture. And with regard to the yield in gold loan, somewhere around 8.85%.
Well, how much, sir? Can you repeat it?
8.85%.
8.5.
8.85.
8.85%. Very good, sir. So that's what only I'm saying, sir, that in case of even some of this lower NBFCs where with a secured business, also you can get a very good margin and can increase the profitability. So having said that, sir, now you in the segment results, sir, I was looking at the segment bifurcation because of this high profitability in the corporate book and the retail book of 269 crores, 390 crores. So overall was 863 crores. Out of that, unallocated expenses of 270 crores has gone for the first time so high as compared to 50 crores, 70 crore unallocated. So what happened this time that unallocated expenses has gone up to so much of 269.58 crores, whereas the segment-wise profitability, if you individually look at treasury, corporate, retail book, and retail banking, then it is 863 crores.
We'll reply. I think let me look into that. This is a fair point, and I'll just look into it. My CFO will inform you separately on this matter.
Arnabji will explain. Okay.
Yeah.
All right, sir. Sir, my last question in this round is basically that the government account, like you said that two state government backed, they slipped first SMA-1 and then part of that SMA-1 and SMA-2. And you need not worry, and you made some reasonable provision also. But is that those accounts are going to slip finally as per the IRAC norm in the NPA category, or before that only they are going to be resolved?
See, these are systemic accounts. First of all, as of now, we don't foresee the accounts getting delinquent. Number one, and I can also tell you, if they do so at any point of time, at present we are having more provisions in a standard account than it is required in a substandard account. So we have built that cushion already. Okay. So, but we don't foresee those accounts because in one of the accounts we had an exposure of 1,500 crores. The exposure has come down to 1,000 crores. Another account we had an exposure of 1,200 crores. It has come down to 627 crores. So the repayments are coming, albeit not at a space that we like to have, but we don't foresee any immediate delinquency in these two accounts.
All right, sir. Thank you very much, sir. I'll give the opportunity to others, but if time permits, I'll come back again, sir.
Sure.
I will discussion and questions, sir. Okay. Thank you, sir.
Thank you, sir. The next question is from Sunil Choksi. Over to you, sir.
Good evening, Mr. Choksi.
Hello. Good evening, Mr. Choksi.
Mr. Choksi, are you there? We can move forward.
Yes, sir. Yes, sir. Yes, sir. The next question is from Jay Mundra. Over to you, sir. Hello, Mr. Jay.
Mr. Mundra, good evening. Are you there?
Can you hear me, sir?
Yeah, I can hear you. Please come in.
Sure. Yeah, hi, sir. Congratulations on a steady quarter, sir, and thanks for the opportunity. Sir, I have a few questions. One is, sir, this quarter we had a stable NIM almost, and negligible credit cost. Right? But still the ROA is below 80 basis point. All other banks, they are now they're very close or higher than 1% ROA. This quarter we had a negligible credit cost and still we are far off from 1% mark. Of course, it is a journey. It may take some time. But I wanted to know, sir, do we have an aspiration for 1% ROA and how soon, can we reach there? Hopefully the NIMs will expand and credit cost may not be negligible, but I do not see any problematic thing on credit cost. So in your assessment, when can we, reach that 1% threshold?
Yeah. I think, Mr. Mundra, excellent question from your side. Very, very appropriate also. You have actually already discussed how we have maintained the September quarter. The ROA part, the net profit actually. Please, somebody please put his mic on mute, please. Others, please put it on number. Yeah. Mr. Mundra, can you hear me? Mr. Mundra, can you hear me?
Yes, sir, I can hear.
Okay.
Yes, sir, I can hear you, sir.
Yeah. So now to your point, coming to the point of your ROA. See, ROA is a component straight away from the net profits. What we have been building, and as you rightly said, that it's a journey. We would like the bank to move in a very, very steady and a very strong footing in terms of our efficiency parameters. So there is a lot of cushion being built up in the balance sheet in terms of our managing our portfolios. In fact, as I said that in terms of the standard account provisioning, we have a ECL framework coming up in future. So we are building up in one of those two guaranteed state government guarantee. We are having provision of 30%. One of them is at 20%. So we are providing more than required. Number one. We also see our increase in our provision coverage ratio is also increasing, and we have also built up cushions in that. We are now our aging provisions are as extended up to October 26. So we are building that we should be ahead of this at least by 6 months in terms of our aging. Why are we building it? Your question could be, when the credit cost is low, what is pushing the bank to these sort of strategies? We are doing it very consciously, Mr. Mundra, first of all, and we would like that the banks, whatever assets that we are having, and any semblance of stress in some form or the other. So we feel that we have a lot of other standard assets. We are in another standard asset from which is technically an NPA. We are having provision of more than 80% in that. So all these, and we don't have too many of these accounts, but whatever we have, because of the size of the balance sheet is small, for 1,000 crores of one corporate, and if that goes bad, it can have a massive impact on the overall scheme of things of the bank. So we are building it steadily, and in terms of the futuristic ROA guidance, we think that ROA of 1% is surely possible by the end of March 27.
Right. Sir, if you see in this quarter, you have made excess provisions and all along you have been, let us say, making some extra buffer. But sir, this quarter the credit costs are negligible, right? It may not become negative, right? Because so I was under the impression that if credit cost is negligible, still ROA is only
0.7.
very minor uptake. Yeah, is minor uptake. I'm saying over the next 5 quarters, even if ROA, asset quality remains steady, but the credit cost will not fall down below this level, right? So credit cost is not a lever anymore. From this quarter perspective, all you have to do is either improve NIM or fee or OPEX.
Absolutely.
It's only 3, right?
Absolutely.
So,
you are absolutely right. Yes. Fee income. If you see, as I was saying, the bank was not doing well earlier in core fee income. Treasury and return off, of course, recovery write-off, they also contribute quite significantly. but those are also part of market dynamics. We are more concentrating on the areas other than these two big non-interest income methods. So our core fee income continues to increase. A lot of stress has been given for revenue to stop revenue leakage, to promote third-party products, to increase non-fund business. In fact, in this time, we have also been able to generate some additional income through our sale of our PSLC. The PSLC component, we have contributed 21 crores in this quarter. So now, with an agriculture thing picking up, the portfolio picking up, we think that we have a lot of scope for increasing getting more and more income through these sort of methods. In terms of futuristic planning, we are going to very shortly implement supply chain financing. We are going to have cash management services by June. So, wherein some of the banks are generating lots of fee income through these methodologies. So, I think your point is absolutely right. We need to improve NIM, and that's why I was talking about how we churn our assets book into the various segments, and also increase our fee income to that. And hopefully, with supported by a good, sometimes good or sometimes moderate treasury performance because of the market dynamics and good recovery. And our slippages continues to be less and less, but our recovery in NP accounts continues to be, lot of focus continues to be given. So in this quarter also we expect around 250 to 300 crores of recovery in the written off account. We expect that. And if all that materializes, it will not add value going forward in our overall scheme of things. So we will focus on getting, generate more and more NII, NIM, and other income from various sources.
Sure, sir. And sir, have you migrated to the new tax regime, or that is, you're still on the old earlier tax regime?
Because but we have taken away, or we have covered all our accumulated losses. So we will look, now the time has come for us to look into this subject, and maybe going forward we will be, some strands are still not migrated. We will look into this, yes. Now we have come to that situation.
Sure, sir. And secondly, sir, on gold loan, right? So there is a 100% YOY increase in the gold loan. Is there any reclassification, that in the sense that earlier you were having retail gold or agri loan, which has now reclassified from agri to retail or retail to agri, or these are all, like to like sort of a number?
Yeah, Mr. Mehra will.
Actually, the gold loan growth is there. I just informed that we have done the co-lending part as well for gold loan. First time we have done it. And 1,700 crore rupees has been done for co-lending. So because of that growth is there. And then there is no reclassification among these three sectors in the gold loan.
I think, Mr. Bhinder, as far as retail and agri classification, that's the dynamics. But overall, what I like to say is that the portfolio as such is growing both organically through our branch network and also through our co-lending platform. Our co-lending has been doing exceedingly well. Our experience has been excellent so far. So we will promote more and more such models of financing, both organically and inorganically. And so far, I think the quantum jump that you see are contributed by both the segments, both on the branch side and also from the co-lending side.
Thank you, sir. Now we will begin to the next participant. Next question we have from Mr. Sushil Choksi. Over to you, sir. Hello, Mr. Choksi.
Yeah, good evening.
Good evening, Choksi, sir.
Good evening, and congratulations on very good numbers for the quarter.
Thank you.
Sir, starting in reverse, going to your guidance slide, you have tick box everything except gross NPA. I know you would not revise, but if on a general discussion basis, what is likely to get further enhanced from where we stand? So Why don't you elaborate? Because these are positives and we are not willing to change our guidance.
See, I think the color combination sometimes may be misleading. Okay, so I'll tell my CFO to be careful in the color combination. Why we have put it in a different color is that we have not reached that level. That's the other thing. We are going to be much better than what we have guided. I can assure you that.
No, sir. I sense in the numbers that your deposit growth is as what the market is estimating and RBI is also forecasting. Your advances are doing very well. Your RAM, specifically second-hand car, solar, agri, housing loan, all are doing well. Your gross NPAs have performed well, net NPAs performed well, PCR is stable, recovery and upgradation, possibly you will far exceed the number what you have said. Yeah. Credit cost is minimal, and slippage ratio is also under control. So I feel that your numbers, outlook, and bank is on a superior stage compared to what you are guiding. So thing is that I just feel that if you can throw a better picture than what you are looking at aspirational on March 26, nobody is going to hold the gun that you have not achieved it. But if you think it is what is going to, so your credit cost, can it collapse from where we are by 1 or 2 notches? Maybe your NIMs can improve far greater, whatever it may be. You may highlight that.
So, absolutely, I think I can clear the air in that manner. See, while we are objectifying that 2.5 is a reasonable guidance, I think we are looking at a number of 2.25 by the end of March. I think that is the number we are aiming.
2.75 or 2.25?
2.25. 2.25.
Okay. Second thing, sir, what is our technology spend and human resource spend? Because we are moving on digitization, co-lending, branches, geographical expansion, new initiatives. So basically, entire staff and technology is a must enabler. So what is that we are going to do different, and what is that spend? We can tell us.
Yeah, I think while I was submitting my initial remarks, I did talk of the areas where we are working on HR front. And among the other host of things that we are doing in various things, I think we have also worked very strongly on the HR front. On the HR front, particularly what we, as in terms of investment, basically we have taken the global consultant who is implementing the best of the HR practices, which is across all the banks, particularly public sector banks. And I think we are getting the best of the benefits. It is not a big cost in that way. And the overall, in the package of things that we are doing, the entire cost is in terms of the engagement of consultant, whether we are taking any tools, on the various tools that have been mentioned in the presentation. I think over 16 to 20 tools are being adopted, or whether it is target setting, whether it is performance management, whether it is other areas. I think there we are investing in terms through a consultant mode. So that's not a very significant number for us to really be worried about. But the point is that on the HR front, and the second phase of the HR transformation that we are doing, it really talks about the leadership development. I think that's the key area which we will like to work on in the current 6 months. It's a 6 months project that we are going to implement, and hopefully at the end of it, we create more and more skill assessments, more and more tools for training purposes, and engage staff members in a much more efficient manner. I can just give you one example in terms of capacity building. What we have done internally through our AI chatbot is our staff members, normally architects, when they are more used to reading WhatsApp messages and circulations that come through WhatsApp, and do not get enough maybe time to read formal circulars in the bank's internal portal. So what we have developed is that we have created an AI chatbot in an internal circulation where any staff member would like any query, when it's a regulatory guideline, whether it's a board-approved guideline, whether it's any SOP, he can just put a chat into that ARIA-bot. We call it ARIA-bot portal in our bank. And through that, he can get an updation immediately with an immediate response through a system-generated AI tool that has been utilized that will give them the immediate answer to a problem that he may immediately face at any point of time. So this is also on a small area which I have talked about, and trainings is another area which are investing very, very strongly. We find that our in terms among the total number of employees that we have, around 10,000 odd, we are now working on how many unique employees are getting trained every year, and that figure is also significantly increasing year on year. Earlier, a unique employee means an employee who is not giving multiple trainings. We were giving trainings to around 3,000 employees. Now that figure is ranging between 6,000 to 7,000. So it's nearly doubled. So a lot of investment is happening there also through our training colleges. We're opening a second Excellence Center Staff Training College, which we'll call a Center of Excellence on Food and Agro Processing. It will be hosted in Chandigarh, and which will give another fillip to our overall capacity building initiatives that we intend to take going forward. Because we all realize that how IT and HR has to go hand in hand in the overall scheme of things for any efficient bank. So we are doing a lot of taking a lot of initiatives. Hopefully, this will all give better results as we go forward.
So, what is the digital spend and human resource spend likely to be additional on all these measures?
On the human resources spend, see, I can give you a snapshot that just to give you an idea of what you are trying to arrive at. In the last 3 years, we have an approved outlay of 900 crores in IT. Okay, I think that will give you an overall idea of scheme of things, which will get utilized as we go forward.
Yes, sir. Yeah, go ahead.
Yeah, please carry on.
Sir, your RAM is doing well. How well efficiently we are able to market some other products, including CASA, to the same customer?
Yeah. So, the next transformation journey that we have decided internally would be on the digital front, which is one of the key area of customer acquisition, whether it is on a liability side or whether it is an asset side. So the bank is internally working out, and I think we'll roll it out by the end of the financial year next, which we may call PSB Unit 2.0, and which we will demonstrate to the external stakeholders that we also have the capacity to turn around a digital oriented customer journeys and with a great UI UX experience, and overall make stickiness. The idea is having more stickiness from the customer perspective, more product per customer, of cross-selling. So as of now, on the lending side, asset side, we are doing a lot of digital transformation in the lending side, but we like to have it a common platform wherein both the assets and the liabilities will be taken care through a very, very robust digital platform. So that is on the offering in the next year. We have taken a lot of steps in various areas. Now, I think it is now culminating for business purpose. The digital transformation will be taken forward. So we will be going through the process, approvals by the end of this month or maybe next month, and then we open it up and we engage somebody which is efficient and delivers to the best of the apps in terms of the industry. So I think those acquisition journeys of salary stickiness and also will work. And one more thing, we are also much more focused on garnering as much salary accounts as possible. We have done a host of tie-ups with various state government organizations to build up this CASA portfolio in terms of salary accounts. And of late, of course, the Central Government Employee Connect program will be across all public sector banks, where central government employees have been advised by their nodal ministries to open all their accounts in a public sector bank only. So we will be, though it's a competitive market, but we think we can have a fair share in that. The defense salary account is playing out very well. Now, earlier we had a centralized Major General who was the central defense banking advisor. We had one person. Now we have 5 persons on the ground to assist the Major General at the center, so that there is a lot of legwork required to mobilize salary accounts of the defense establishment. And I think we have recruited them. They are already on the job. They are going places, and we are getting a lot of positive feedback that going forward, we may make some significant breakthroughs in the defense account, salary account as well, including MDB sector, because our package is one of the best, if not the best, it is one of the best amongst all the banks that offer the products to the defense people. So stickiness of customer would be important, giving them good UI UX experience, give them all the facilities under one mobile app to maintain accounts with us, have good credit card business, mutual fund business. So put them all together and try to build a robust digital journey. So these will be some of the few points which will be taken forward in the next financial year.
Sir, my next question, what is the unavailed credit limits which you have sanctioned in recent months, and what is the pipeline looking for the quarter, specifically on the corporate side?
I think on the corporate side, overall, if I see the sanctions in hand, the undisbursed portion, the proposals under consideration with a good NBG in principle approval given, which are going to get converted. The overall pipeline so far is 20,000 crores.
Okay. And does it give you a color of any kind of sector, or it is across?
It is across. We are now getting into the, of course, NBFCs, we are there, but other than that, we are into we're looking for good infrastructure, LRDs, real estate, good real estate projects. If we get something, renewables, manufacturing, we are now getting into cement. We are getting good leads. Many of the big corporates, the cement manufacturing companies are in touch with us, and we hope that at least 1 or 2 of them will be converted in terms of our acquisition. So manufacturing is there. A lot of state government entities who are doing well in the power segment are also bringing out new capex programs in their respective states, and we are also giving them line of credits or credit lines in those areas, whether it is Northeast, Central India, Northern India. We are getting it from across the country, Orissa, Andhra. So now our business expansion is really being taken forward in the geographies which we think are going to be very important. Today, whether it is the central part of the country, southern part, eastern part of the country. So we are going to expand our business horizon across this, and that's why we are making a lot of visits. MDs, EDs are visiting them, meeting the chief ministers, top bureaucrats, meeting top officials. Anywhere our MD or ED visits, we generate at least 5,000 crores of leads. That's the bottom line we have taken, that if any MD, ED goes to a visit in a particular zone for business mobilization, that zone should generate 5,000 crores of leads. Otherwise, we don't go. Initially, people were hesitant. I think now it has picked up, whether it is Gujarat, whether it is Chhattisgarh, whether it is Orissa, whether it is MP, Madhya Pradesh, Karnataka. I think that's how the things are moving in the bank, and I'm very sure as we move more and more, these will be converted in a better way.
So then you need to accelerate your deposit, nothing more.
Yeah. That's true. That's true. Or we find an alternative way of funding and maintaining the LCR. But that situation has not come yet. Many banks on the CD ratio are already at 82, 83. We are at 79. We'll work on that leeway that we still have, and then take a call. Of course, deposits will be very important. I agree with you.
Yeah, because 5 states itself amounts to 25,000 crores. Sir, my last question to you. You have been, you understand treasury well. What is it today that rates are where it is, and what's the outlook? Second thing, how do you manage cost of funds better than where we stand today in near quarters?
Yeah. In terms of the outlook, you know that the yields have hardened and a lot of dynamics are happening, particularly on the SDL front. We expect that the Reserve Bank is, I'm very sure the Reserve Bank is looking very closely on it. And there has been, I think the OMOs, subsequent OMOs may again come. There's a lot of discussion going on that OMOs may be brought in. There was also, I feel that some of the SDLs, which RBI has experimented earlier, in the OMO, they have not of late done that. Maybe some SDL, because the hardening is happening in the SDL front more, the spread is increasing more there. RBI may consider as a measure to bring down the yields from that perspective. But the global situation is something is very dynamic. I don't expect immediate cuts happening in terms of it. The numbers, the GDP numbers are also holding on, which doesn't really trigger any potential action by the Monetary Policy Committee. So, in the scheme of things, as we stand today, I feel that the RBI will have a wait and watch. We have a long pause maybe in terms of the overall guidance, and take it every 2 months going forward. That's on the treasury front. And what was your second point?
Cost of funds.
Yes. On the cost of fund, we have brought it down. In fact, if you see our trajectory in the cost of deposit and cost of fund, we have taken a lot of steps, and that is actually yielding a lot of results. We have priced our savings very aggressively, and we don't find any challenge there. Savings continues to grow. We feel that today is the stickiness of the customer which gives the bank savings accounts. So we have drastically reduced our savings deposit rates. We have drastically reduced our retail term deposits, particularly on the special schemes. At one point of time, we were giving as high as 7.45% in the retail term deposits in one of the brackets. That has gone down to 6.60. And that, if you see our sequential movement in the cost of deposit and the cost of fund, we feel that there is some positive development there. What we now need to do is increase our yield on funds and the yield on advances. So that is a work in process, you may say.
Sir?
Thank you.
Thank you. Next question we have from another participant, call in user. Dear participant, could you please introduce yourself and come up with the question?
Good evening.
So we'll move on to the next question, which is from Hriday Choksi.
Good evening, sir. Thank you for the opportunity. So one very quick question. You earlier guided on our vision for a 1% ROA over the next few quarters. So looking at the numbers, so we have a very volatile and a much higher cost-to-income ratio versus majority of our peers. So what is our vision in bringing this down? Because you spoke a lot about digitization and operations. So where can we bring this down to, and how do we move to that 55% target? And then, because this will also eventually help our ROA. So what is your guidance here?
Yes, absolutely right. The only solution is to increase income. Cost is only a limited impact that happens in terms of reduction in cost. So our entire effort, traditionally our bank's cost-to-income ratio has been very high. So the only way is to generate more and more income out of our business models. So we expect that our idea would be, if all the things work out to the way that we have planned out, I think by the end of March 27, we should be nearly around between 50 to 55%. I think that's the overall dynamics that we are working on. We'll try to phase it by 3 to 4 bps every year. And if you see our trajectory so far, we are holding on to that earlier, it was 75, At one point of time, earlier in the bank it was 72 also. So now we are able to maintain the 60 to 64, 62 or 64 range. We expect that this range will come down to around between 55 to 60 very shortly, not 58 to 60, and then move on to a range between 53 to 56 somewhere. It will stabilize. So another 2 years down the line, we should be having a much better cost-to-income ratio. The only way to do it is to increase income, and that's what I have been telling all along, and that's what we are trying to do also. If you see our fee income in going up, our churning the balance sheet, etc., which I have already said. So that will continuously take this going forward.
Noted. Thank you very much.
Thank you.
Thank you, sir. As there are no further questions from the participants, we now conclude this conference. Should you have any further queries, please reach out to Mr. Ganesh Hankannar at 77386 or ganesh@conceptpr.com. On behalf of Punjab and Sind Bank, I thank each one of you for joining the conference call today. You may now disconnect your lines. Thank you. Have a great day.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.